Hey boys and girls, today we're diving into a topic that's crucial for anyone working or doing business here in Singapore. Whether you're an employee or a foreigner running a business here, it's essential to understand how these laws impact you. First, let's talk about the basics of Singapore's tax system. Singapore operates on a territorial basis of taxation. This means that taxes are imposed on income that is accrued or derived from Singapore, as well as foreign income remitted to Singapore. Now, if you are a foreign employee working in Singapore, here are the key points you need to know. First, the difference between a resident and a non-resident. Your tax liability depends on your residency status. If you stay or work in Singapore for at least 183 days in a calendar year, you are considered a tax resident. Otherwise, you're a non-resident. Next, let's talk about the tax rates. Tax residents benefit from progressive tax rates ranging from 0% up to 22% on their chargeable income. Non-residents, on the other hand, are generally taxed at a flat rate of 15 to 22%. Directors' fees are taxed at a flat rate of 22%. Foreign income received in Singapore by individuals is generally not taxable. So let's move on to foreign businesses operating in Singapore. Singapore has a flat corporate tax rate of 17%, but there are various incentives and exemptions that can effectively reduce your tax. A company is considered a tax resident if the control and management of its business is exercised in Singapore. Tax residency is important in order to access benefits under Singapore's tax treaties. So to avoid double taxation, Singapore has agreements with many countries. These treaties can provide relief through reduced withholding tax rates and tax credits. Payments to non-residents may include interest, royalties, service fees, and these may be subject to withholding tax, which may be reduced under the different tax treaties, which depends on which country you're from or where you are domiciled. Another thing to note is that Singapore imposes a goods and services tax, which is currently 9%. Businesses with an annual turnover exceeding 1 million Singapore dollars must register for GST, although voluntary registration is possible for businesses below $1 million. And this is beneficial for claiming input tax credits. GST is a consumption tax that is levied on the supply of goods and services in Singapore and also the import of goods into Singapore. It is similar to the value-added tax, VAT, that is seen in other countries. So, GST registered businesses must charge GST on their taxable supplies. They also must file regular GST returns and maintain proper records. Non-compliance can result in penalties and fines. You may have heard the joke that Singapore is a fine city. You can get fined for spitting, you can get fined for littering, you can get fined for not flushing the toilet, you can get fined for this, get fined for that. So know your tax obligations. One last thing to note. The penalty for tax evasion is 4 times the actual amount of tax that you are supposed to pay. Thanks for watching and see you in the next video.